Mr. Gupta, can you hear me?
Yeah, now I can.
Hi, sir. Good evening. Prashant here. We're
Good
just
evening.
starting.
Good evening, Faisal. Thank you.
Good evening, ladies and gentlemen. Great to have all of you here. We are, of course, coming to you from the sidelines of the Motilal Oswal Wealth Creation Study. It's the 29th edition. Each study, of course, is something to behold. It's a study into which a lot of hard work goes in. Raamdeo of course, spearheads the study, but an entire team is involved. And of course, it's been our pleasure at CNBC TV 18 to bring this study to you year after year. As I said, it's a 29 study. Ramdeji was earlier joking with me that at least about 5 years of his life have gone into the wealth creation study, maybe more. And we'll get to it in just a bit. Uh, it's a very specially curated panel that we have with us today because we'll hear not just from investors. We have Raamdeo Agarwal, of course, with us. Amit Goyla needs no introduction as well. He's a veteran investor, partner at Rare Enterprises. He's been with Rakeshji's side for 20 years plus, and he's of course seen the ins and outs of markets for a long, long time. But we'll also hear from corporate veterans. Anish Shah is Group CEO, MD at Mahindra Group, someone under whose watch the Mahindra stock has gone up about 4 times. Anish, great to have you with us here. Thank you very much. And of course, Mr. Akhil Gupta joins in as well. He's of course Vice Chairman at Bharti Enterprises, someone who's again been in a sector which is, I think, has been a tricky one over the last 2.5 odd decades. But Bharti, of course, under his leadership, has emerged as a big, big winner. So once again, thank you all for being here. Now, the topic for the discussion, of course, is how to profit from bruised blue chips. And that is essentially what we're going to be talking about. There is, of course, the wealth creation component part of it, which I will get to in just a bit. But I think it's really interesting how to profit from blue chips which have fallen out of favor, bruised blue chips, as Ramdeo put it in his study. So, Ramdeo, why don't you set the context for us? What do you mean by bruised blue chips? Uh, how do you decide that they are really bruised? And how does repair happen? And when do you buy them?
So I think there are two aspects. One is the definition of blue chip itself, and then how do we define the bruised blue chips? So blue chips are the companies which, in our view, earns at least 20% return on equity for average return on equity for 10 years, and that does the magic of creating wealth for the companies. So 10 years of average return on equity, there are not many, maybe 20, 25%, 22% of the listed companies in top 250 are blue chips. And then also by size. I mean, you need to have size and stability leadership. So top 50 nifty companies and the companies of 250 at the companies with 20% ROE, we have termed them as blue chips because blue chip is practiced all over. Everybody talks about blue chips, but nobody tells the definition of blue chips. So we have defined for the study definition of blue chips. Second is what is a bruised blue chip? Bruised blue chips, the companies in last 5 years, whatever is the high, and now the companies have fallen by more than 50%. Say if company has gone to say 1,000 and it has fallen below 500, 60, 70, 80%. So those companies are bruised. They have not lost the blue chip status, but for some reason, competition or failure products or regulator or whatever, the stocks have fallen by more than 50%. That we call them bruised. So these are the two things which we have to keep in mind while talking about bruised blue chips.
Typically one would imagine, Ramdeo that blue chips don't get bruised, right? Once in a while they do. COVID happens or the GFC happens, but otherwise blue chips are blue chips. But as your study shows, they do, and quite regularly.
Yeah, quite regularly, every year. I mean, if you see the study period of 5 years, every time out of 250, 78 companies are the blue chips on an average. And of that 40 or literally half, they get bruised. Other half, they don't get bruised, as you say. But 40%, so no blue chip has traveled the journey without getting bruised. Maybe TCS or Infosys might be two or three companies, but actually almost all the companies they go through a rough patch, and that is the point of time when they're deeply bruised. I think if you understand the company, you can buy tons of them.
And as your study shows, the hit rate is pretty good when you buy them at that very, very bruised state, you tend to make a lot of money.
I have not practiced. Probably Amit can talk more about it because for me this is just the study.
Right.
But if you practice it, I mean, few companies I know for sure which came to my mind. That was one of the Jindal Steel. Since I know that company, DLF at 70, 80 rupees, I have gone on record saying that this is a great time to sell your real estate portfolio and buy into DLF. So 2, 3 companies I remember, but I have not made too much of money out of bruised blue chips.
I mean, that's a cue for you. Raamdeo says he's not practiced it, but you've been a big practitioner over the last 2 decades plus. So tell us a little bit. I mean, you heard the presentation earlier, you heard Raamdeo explaining it.
One of the core style of dear Rakesh and your mentor and partner and boss. I mean, I think he had the unique style of picking these companies because whenever I used to meet him, he used to tell me, "This is the Raamdeo, this is the stock I bought. Why don't you buy them? Chahe Scores ho, chahe Indian Hotel ho." But I never could see the light of why he's saying so. In fact, I used to feel this guy is already drunkard and probably he's telling me something which he wants to pass off. I mean, that used to be my feeling. I never made money out of it. And he was so sincere. He always wanted me to make money. And now I can see that what he wanted. But it's too late. Anyway, Amit.
Yeah, Raamdeo, thank you for having me here. So Prashant, as you said, I've been with Rakeshji. So Rakeshji was the practitioner of this kind of investing. I was supporting him, I was helping him doing the work. But the real practitioner of was Rakeshji. And I've seen him consistently over a period of time pick stocks like this which were in trouble or the companies were in trouble and he's made serious money in them. And the quote, the starting, he never coined them as a bruised blue chip or anything of that kind. He was a value investor. And his starting point was that cannot be a loss of capital. See, he would invest through leverage. And he would service the debt through either dividends or from trading income. So there was no question of a capital loss. So anything which was like a book value, though I don't even remember calculating too many times around when I was around him. But PE was quite critical and dividend, like sometimes most of these companies were not even giving a dividend because they were in bad shape. So the PE was very critical. The market cap in terms of the opportunity, that was very critical. Those are the couple of things he would look at. And his basic core was there cannot be a capital loss. So he said, my edge is I have time on my side. I'll keep sitting tight. I don't have any benchmark to beat. I don't have to prove anything. And so I will remain invested, but I cannot have a capital loss. That was his basic core of investing in these kind of companies. And he had a very open mind. So it was not, I will only look at one sector. He invested across sectors. We were sector agnostic. Yeah, like so.
You know, let's get this very well put, Amit. Anish, we get the investors' viewpoint all the time, but it's a hall full of investors waiting to hear from you and Akhil. You came into Mahindra & Mahindra, and I dare say, M&M was not bruised, but it was going through a tough patch. And you came in and you turned things around. Talk to us about that point when you came in. What was on your mind? What was the task given to you? And generally, what were the conditions? I mean, what was the experience like?
The start of the first phase of my role, the first year was as Deputy MD and Group CFO, began on 2nd April 2020. And that was a time when we had just hit a low point. The stock had lost about 70% of value. SsangYong was a major burden, and we had close to 5,000 crores of losses from what I called our loss-making entities. And as a result, the results of that year were just about break-even. And it was the start of COVID, and no revenue for the first month of April. So that was the starting point. But the foundation was very strong. And that's one thing I want to highlight in terms of the Bruce Blue Chip story, is that the foundation had been built over many years. And in fact, it was a Motilal Oswal analyst report that in 2018 had highlighted that M&M was the best performing stock in the Nifty since 2002. And that doesn't happen easily. So there were many elements of the company, of the group, that were important and took us forward and helped us weather the storms. Yes, there was some reason for the storms, but the people we had, the talent was of a completely different quality. The ethos of the company, the purpose-driven approach, um, the focus on entrepreneurship, all of those were elements of the DNA of the company. And which is why even through those storms, we never really were very concerned because we knew that we were going to get out of that very easily. So I give a lot of credit to our predecessors who really helped set us up for success. And we had to just go forward and implement the few things that we felt were important.
You're being very humble, Anish, and very nice to people who, of course, and rightly so. But I think what we want to know is what did you do? I mean, you set the ball rolling. You set ROE targets, and you sort of decided to sell off some of these unrelated diversifications and all of those things. I mean, just talk us through. I mean, the point that Raamdeo made: external mistakes, internal. Sometimes you kind of sort of go astray. Large companies. So just talk us through those moments and what you saw.
So let's start with the losses. Right? We knew that we had to address that and we had to do that quickly. And therefore, we created a list of companies that made that 5,332 crores specifically of losses. SsangYong was highest on the list with 2,400 crores of losses that year. And we said that if we are to be credible, that's the first decision we have to take. And Raamdeo is right. A lot of people at that point said, you said this, but it's not going to happen. Right? And therefore, we had to make that happen. But that wasn't enough because we still had another 26 or 2,800 crores of losses. And therefore, we had to exit a number of other companies and we categorized them. We said, look, some of them actually could be good jewels for us if we can turn them around. So our categorization was category A, companies that can be turned around, and they will be companies that we'll be proud of and they can meet our 18% ROE target. Category B, companies that will likely make some losses but have a quantifiable strategic benefit for us. And category C is none of the above, and therefore they need to exit. And we exited 15 companies in the next 18 months or so. And we just moved very quickly and did that. We did not wait in terms of any sequential order. We just started that simultaneously. So that was the first big step. The second big step was pivot to growth. Because just meeting an 18% ROE target is not enough. If you don't see EPS growth as investors, it doesn't matter from an investor standpoint. So we very quickly pivoted to growth from there. And we identified a set of companies that we thought were very strong and what we call the growth gems. And these were strong because they had a strong position in their industry, at least from a potential standpoint. They had a strong, what we call, right to win. And these growth gems collectively had valuation of less than $1 billion in March 2020, close to about 900 million. And the first thing we did there was to say that if you have an aspiration to be $1 billion company standalone, you will be called a growth gem. And the aspiration has to be matched with a plan that in the next 3 to 5 years, you will be $1 billion company. 3 years later, the collective group had gone from 900 million to 3.4 billion. And we raised the bar. At that point, we said that to stay a growth gem, you got to now grow 5x in the next 5 to 7 years. So that 3.4 must go to 17. And that's one part of what's driving our growth now, is the ambition as well as the ability to then deliver on each of our businesses.